Hi, I'm Ryan, and thanks for tuning in to Market Lab. Today's video is part 2 of a 2-part series on the main ways to value a company. Last week, we did the discounted cash flow model, so that means this week is on comparative trading multiples and precedent transactions. All right, let's get into it. We started our last video by stating that there are different ways to value a company because there are a lot of different ways to look at what value is. In the case of a discounted cash flow model, the value is determined based on the estimated present value of all future cash flows that may accrue to the company from now until infinity. While subjective, looking at value in this way, we are trying to gauge the firm's intrinsic value, the fundamental, internally derived value of something. With comparable trading multiples, however, we are externally deriving the value of something based on how other related assets are valued. For example, imagine your friend just bought a new car for $75,000. And since your car is very similar in so many ways, then surely your car must be worth the same. Well, maybe not. Looking at multiples to value things can be quite tricky and isn't a perfect science. In this video, we're going to try to walk through some of these complications and nuances, but first we need to get a handle on the mechanics. Comparable trading multiples revolve around the idea that the relationship between an asset's value and a financial metric, typically a measure of its profitability, holds important analytical value to the investor. The most common type of multiple out there is a PE, or the company's price to earnings multiple. Let's say there's a company with shares trading at $20 on the stock market and earnings of $2. The PE multiple of this stock would be 10 times. Now, it can get a lot more complicated than this, so let's walk through an example. Pretend we're looking at the pre-compressed helical spring toy market, with several competitor companies and varying degrees of growth and quality. To get their PEs, we start by collecting each of the company's share price. Next, we need to get their earnings per share, or EPS. But which EPS? Okay, so there's lots of different choices: quarterly, annual, backward-looking, forward-looking. To start, we need an annual figure by convention. But even from here, there are several options for us to choose from. There are historical fiscal years, which in the case of companies with traditional December fiscal year ends would mean earnings per share for calendar years 2020, 2019, 2018, etc. Or the LTM, which stands for the last 12 months. As of the making of this video in October 2021, that would mean the 4 previous quarters ending with the September 2021 quarter. The problem with those figures, though, is that all this information is in the past. Even in the case of the LTM figure, which just ended a few weeks ago, is referring to a company that, without getting all existential, no longer exists. This information is stale, and a lot could have happened to the company since then. As investors, we only really care about the future and not the past. For example, failing Chinese real estate giant Evergrande looks a lot different this week than it did when the company most recently reported. Using a historical multiple that doesn't incorporate this new information is myopic, and that's why, generally speaking, we only use forward-looking multiples, typically estimates of a company's current or next fiscal year end. Using estimates for the future incorporates the latest information on the company's financial health and opportunities. So, in our example here, that would mean EPS estimates for 2021 and 2022. With these in hand, we can calculate what the forward multiples for these periods would be. So, now that we've calculated the multiples for these companies, we should probably find a use for them. Let's imagine a new company was going to IPO and have its stock listed on the public markets. This company, let's call it Slinky Lab, released some financial data in its S1, and from there you were able to build a financial model of them. From it, let's say that we estimate that in 2021, revenue would be up 5 to 6% from the previous year, and the earnings per share would come in at around 50 cents. So, for simplicity, let's imagine that all these companies are virtually identical. Same management, leverage, quality, etc., such that the only differentiating factor here is the growth profile. Now, as we can see here, there's a pretty strong relationship between revenue growth and PE multiple, so we can use this information to come up with a reasonable multiple that we would feel comfortable applying to Slinky Lab for our valuation. Based on this relationship, our estimate for Slinky Lab's growth in the 5 to 6% range, a reasonable figure might be to say 16.4 times. Going back to our previous example, with our estimate of 50 cents for Slinky Lab's 2021 earnings per share, applying the 16.4 times multiple would imply a target price of $8.20. Alright, so keeping this example going, let's imagine that Slinky Lab did IPO and is now trading at $11 a share. Our estimate of 5 to 6% growth hasn't changed, so this would imply that Slinky Lab is now trading at a 22 times PE multiple. As we can see here, that's pretty out of whack from where the peer group is trading. So now we might consider selling Slinky Lab short under the thesis that it will eventually revert back to a multiple more in line with the sector relative to their expected growth rate. Trading like this is a type of mean reversion strategy. In the example here, we see a stock trading out of its historical range. The stock has broken out and is well above the scope that is normal for it. Using a mean reversion here would attempt to see it compress back to the 8.5 to 13 times PE range. A related concept to this is called a pairs trade, where a long and short position are made on two securities that are highly correlated. Now, a pairs trade can be put on for a number of reasons. One of which, though, is if two stocks tend to trade at a similar multiples, but for some reason that relationship has broken down in the short term and the trader expects that it will resume again soon, either by the weaker performing security increasing in value, the stronger performer declining, or some combination of the two. In the example here, we would be expecting some mixture of company A weakening and company B strengthening. I hope so far we've established that multiples are important and can be very interesting to investors, but we don't want to get ahead of ourselves. Multiples have limitations. I don't think it would ever be wise to trade simply off of a company's multiples without doing the work to understand the underlying business and its fundamentals. Multiples are tools in the investor's toolbox, something to help with timing entries and exits, but are not an end in themselves. Like the great man said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Multiples might be useful in determining if a price is fair or wonderful, but it won't help a bit in determining if a company is good or great. Okay, thus far all of our examples have been based on the price to earnings multiple, but that's definitely not the whole story as far as multiples go. PE is the most common, but not the only one relevant to investors, and for some industries, PE isn't even used at all. After PE, the most common multiple you hear of is EV to EBITDA, the company's enterprise value as a ratio of its earnings before interest, taxes, and depreciation. Enterprise value refers to the total value of the firm, which is its market value or total value of its shares, plus other owners of the company, namely debt holders, less any cash the company has on hand. In the same way, EBITDA is the measure of profitability for the company as a whole, compared to net income or earnings per share, which just relates to equity holders. This is why you'll never see a price to EBITDA or an EV to net income multiple. It doesn't make sense to compare profitability of one group of owners to the total value of all groups, or vice versa. The mechanics of calculating EV to EBITDA aren't too hard. EBITDA starts off in the same way as net income, but noticeably we exclude any depreciation that may be baked into operating expenses. As discussed, enterprise value is just a single step further than market cap. And then, voila. So, we've established that EV to EBITDA relates to all owners of the company versus PE, which is just related to the equity holders. But how is that any way more helpful? Why don't we just use the PE and save ourselves the trouble? Well, there are a lot of good reasons, such as discrepancies relating to capital structure and income statement items. To illustrate this, imagine there are two identical companies. Same revenue, same gross margins, quality, etc. The only difference is that company B thinks its shares are undervalued in the market and decides to do a stock buyback by issuing $100,000 in bonds and buying back 1,000 shares at $100 per share. Now, if there's no change to the stock price, the enterprise value will be the same. We've just swapped debt for equity. Moreover, while company B will now be paying more in interest expense because of the new debt, that falls outside of EBITDA, so both companies will still have the same EBITDA. However, because of this increased interest expense, net income will of course decline. But importantly, because of that reduction in shares outstanding, the company will actually see its earnings per share increase. In this situation, the addition of debt was accretive to the company, meaning that its earnings per share increased as a result. And now, we finally get to the point of the exercise. Because enterprise value and EBITDA are unchanged, both companies still have the same EV to EBITDA multiple. But the different capital structures, share counts, and interest expenses have resulted in significantly different PE multiples. But which one is right? As you may have guessed, it depends. In this example, adding debt was accretive as it boosted earnings per share. Higher earnings per share generally means a higher share price, in which case we should trust the PE multiples that imply that company B is undervalued. But it's not that simple. For other companies, the addition of more debt could hurt the share price because of increased risk of bankruptcy and higher borrowing costs. In that case, the PE multiple may be distorted and not reflect the negative impact of increased leverage. The end result is that the investor will need to weigh all factors when making their investment decisions and only use multiples as one aspect of their decision-making criteria. Alright, so what about the rest? So far we've just focused on PE and EV to EBITDA because they're the most used and the most universal, but there are plenty more multiples that show up here and there. The main system of classification is to look at multiples as either ones that use an equity price, like a PE, or an enterprise value, like EV to EBITDA, as the basis for their analysis. To break things down differently, I'll classify them into two groups, financial multiples and industry multiples. But that's just one way to look at them, and honestly, I just made those terms up. I use the term financial multiples because they use a number from the company's financial statements to define the denominator in the ratio of the company's equity or firm value. PE and EV to EBITDA could be classified in this way, but other examples include price to sales, which, in the same way that PE tells you what the market is willing to pay for $1 of earnings, tells you what they're willing to pay for $1 of sales. This is generally less relevant to investors than PE, since companies can vary greatly in their profit margins, i.e., companies with similar price to sales ratios can have greatly different PE multiples. But for growth companies that haven't yet turned a profit or have tiny earnings, this may be the best approach that the investor can take. In this example here, we have three companies: a mid-cap with a respectable 17% profit margin, a small cap that has only recently achieved profitability, and a startup that is running at a loss. As much as we would love to use PE here, you can see that for the small cap and the startup, the figures are basically useless, but price to sales actually adds a little bit of value. Another common one is price to book, where book refers to the book value of the company per share, i.e. its assets less its liabilities. Historically, this was quite useful to value investors before markets got efficient. As you can imagine, being Ben Graham or Warren Buffett back in the day looking for companies that trade at less than the value of their net asset, it worked out pretty well. But now with greater access to information, this multiple has become basically pointless for most industries. I won't delve too deeply on this, but the difference in asset efficiency and distortive things like intellectual property make the resultant multiples not really comparable. As you can see here for these select big tech companies, price to book really doesn't tell us much. That said, for some industries, it is still quite useful when assessing value, such as the banking and insurance industries. For example, for an insurance company, most of its assets are the premiums that have been paid to them and invested. The size of this investment pool gives direct insight into the future earnings potential of the business. And here you can see that price to book is actually quite useful. Lastly, it's worth noting that there are a lot of investment metrics out there with the term yield that are basically inverted multiples. Note that a company that trades at a dividend yield of 5% or a free cash flow yield of 7.5% is also trading at a price to dividend of 20 times and a price to free cash flow of 13.3 times. Convention can be weird. Next are industry multiples. The idea here is that instead of a financial operating metric like earnings, the denominator is a non-financial metric, such as a production figure or customer base. For example, the oil and gas industry uses price per flowing barrel, which is essentially enterprise value divided by the number of barrels that the company produces per day. Mining companies, typically smaller ones with limited production, are often looked at as a multiple of their resources in the ground. For example, a gold company with a $500 million enterprise value and an estimated reserve base of 3 million ounces of gold can be looked at as trading at an EV to reserve ounces of $167. Now that we have a handle on all the inputs, a final piece of the puzzle is to put things into what investors call a comp table, a visual representation of the comparative metrics and valuation multiples of a company and its peer group. Revisiting our old company Slinky Lab, we can see here that they have strong growth relative to their peer set. In fact, they have higher growth than their fastest growing peer. But, as we can see here, they trade roughly in line with the peer set, and actually at a pretty material discount to company D. Now, as I've stated before, investors shouldn't make decisions based blindly on comparable trading multiples. You need to do the work and build a deeper understanding of the company and its future potential. For all we know, the market could be factoring in a lawsuit, a labor dispute, or a missed future product cycle that doesn't make its way into the numbers until a few years out. While it looks like there could be an opportunity here to buy Slinky Labs shares at a discount, an investor's first thought should be now to investigate if there's a reason for this discrepancy. So that about wraps it up for comparable trading multiples, but a closely related concept we're going to discuss briefly is that of precedent transactions. In both cases, the investor is trying to use a ratio or multiple approach to analyze the firm or equity value of a company relative to an operating metric like earnings per share or EBITDA. The difference is that in a comparable trading multiples approach, the reference peer set is currently trading in the market, while the peer set in a precedent transaction approach uses the takeover prices used in historical M&A deals. Typically, the metrics are the same. If you would be looking at PE and EBITDA for a company under a comparable trading multiples approach, then you would be using PE and EBITDA in a precedent transactions approach. To sketch out an example here, imagine that you're the head of a large toy company and looking at acquiring our old favorite Slinky Lab. To complete this analysis, we need to do some digging, or rather your investment banker does, to find similar companies that were involved in M&A transactions. The closer the industry, size, and recency, the better. Let's say that we find acquisitions of Toyco, Helix Industries, and Funtime Games, and think that they're the best representative deals to look at. Checking out their press releases and media coverage, we can then build out a table similar in the way we would for a comp table, except with a few key differences. Firstly, instead of using the current share price and enterprise value, we use the actual values used during the takeout. Secondly, we only use historical information. Recall that I said before that for comparable trading multiples, we almost always want to use forward-looking data based off our estimates or the estimates of the street. In this way, our multiples incorporate all known information about the security. With precedent transactions, however, we don't do that for a number of reasons and can only use historical information. Firstly, if you're the M&A investment banker pitching the deal to your client and want to say that Toyco got bought at X times its next year's estimated earnings per share, then when were the estimates from? When the deal got announced or when it closed, because those estimates would have changed by then. The banker would be incentivized to take the number that helped out his cause. Next, you can't say Slinky Lab should be bought for X times its next year estimated earnings per share, because what happens next week when an analyst changes their estimates? Do you change the deal terms? And most importantly, what estimates are you using? For obvious reasons, the investment banker would be incentivized to only include the analysts in their estimates that make the company look more valuable, or pick the ones that it thinks will most likely get the deal done. Goldman's estimates too low? Well, ignore them. They don't understand the company. As a result, the most legally sound and bias-free methodology is to use historical figures, typically the LTM or last 12 months numbers that capture the company's most recently reported 4 quarters prior to the deal being announced. Lastly, precedent transaction values are typically higher than the equivalent comparable trading multiples for the same period due to something called a control premium. The control premium represents the additional value a buyer is willing to pay over the market in order to acquire a controlling stake in the company. This premium can vary significantly. I've seen biotech companies taken out at premiums of more than 100% of the value that the company was trading at before the deal got announced, and other companies bought for single-digit premiums. Theoretically, the maximum value a buyer would pay is equal to their perceived view of the intrinsic value of the firm plus synergies, the value from combining the two companies, such as reducing redundant business units, plus the opportunity cost of not acquiring the company. For example, if a competitor is going to buy them and become a greater competitive threat. So that about wraps it up for comparable trading multiples and precedent transactions. I hope I've done a good job highlighting that they are a vital part of the investor's toolkit, but importantly, that they can't be viewed in isolation. The goal of the investor should be to analyze the company and build a deep understanding of its future profit potential. From there, multiples should be viewed as guideposts and potentially aid in deciding entry and exit opportunities. From my perspective, an overly dogmatic approach to looking at a company's multiples can lead investors into 2 major investing pitfalls. Firstly, there are value traps, companies that a value investor might buy because a stock looks relatively cheap to its peers. This works if the company is financially sound or is turning its business around, but often the market discounts these companies for a reason. For example, imagine a company that trades noticeably cheaper to its main peer. You might think that this represents an opportunity to buy the stock at a discount, but the growth rates are materially different. In this case, the multiples of either company don't actually have to change for you to lose out. The better company just outgrows their weaker one, and now its multiple is based on a higher denominator. Next, focusing too hard on what looks expensive on a multiple basis can lead investors to shy away from the truly transformative companies out there. A lot of investors are kicking themselves because over the last decade, they thought a PE premium of 10 or 20 times for Amazon was too expensive. Meanwhile, the stock is up 1,400% since then. A great growth investor I know liked to say that the best trades he ever made were buying stocks at high PEs and selling them when they were at low PEs. While this may be counterintuitive, the punchline is that if your EPS has grown 500%, it doesn't matter if your PE got cut in half when the company matured. Alright, so that's all we got for today. Hope you enjoyed the video, and if you did, please consider giving us a like. Thanks for tuning in to Market Lab.